Three.
Good morning, candidates. Yesterday we saw profitability ratios. Today we will see about solvency ratios. A business entity is said to be solvent if it is able to meet all long-term and short-term financial obligations without any strain. Long-term solvency ratios. First one is fixed asset ratio. That is equal to fixed assets divided by long-term funds. Fixed assets include net block and other non-current assets such as investments. Long-term funds includes capital, reserves, and long-term loan. Interpretation: the ratio should not be more than 1 because if the ratio is more than 1, it indicates that the company has created more fixed asset and investments by diverting short-term funds and may create liquidity crisis. The asset ratio of less than 1 indicates that part of the working capital has been funded through long-term funds. Ideal fixed asset ratio is 0.67. Lower the ratio is better from liquidity point of view, but much lower indicates that the unit is conservative for investment and future expansion. The first one was fixed asset ratio. It is fixed assets by long-term funds. Next one, debt equity ratio. Total long-term debt divided by shareholders' funds. Shareholders' funds include paid up capital plus reserves and surplus. Interpretation: the ratio indicates the extent to which the unit depends on outside funds to finance its long-term requirements. Lower ratio indicates the firm is solvent in long term. Short-term solvency ratio or liquidity ratio. Current ratio, current assets by current liabilities. Current assets includes cash, inventory, receivables, and other current assets, which is convertible into cash during the operating cycle of business and maximum within 1 year. Current liabilities or the liabilities payable within a year, which includes bank cash credit or overdraft, sundry creditors or outstanding, installments of term loan repayable within a year, and other current liability. The ideal ratio is 1.33 as per Tandon Committee recommendation second method. That means the promoter's margin is 25% of the current assets. Lower current ratio indicates liquidity risk in business, and much higher ratio is also not desirable as it indicates less efficient use of long-term funds. Thank you.